Support and resistance is often taught as a beginner strategy, but here's the twist. It's actually one of the most misunderstood concepts in trading. This is the guide you need to watch if you really want to trade these levels like a professional trader. Trading is all about finding edges, and support and resistance levels are one of the most powerful edges you can have. But these invisible lines on your charts can make or break your trades. Basically, support and resistance are price levels where the market tends to pause or reverse. Support is an area that catches falling prices. Resistance is an area that stops prices from rising further. And it's all about supply and demand. At support, buyers step in. They see the price as a bargain and start buying. At resistance, sellers take over. They think the price is too high and start selling. Here's the key. These levels aren't exact prices. They are more like zones where interesting things happen. But why should you care about support and resistance? First, they help you understand market structure. You can see where price is likely to pause or reverse. This knowledge is gold for timing your entries and exits. Second, these levels show you where other traders are placing their orders. Big players often cluster their orders around support and resistance. And when you know where the big money is, that's your edge. We'll talk about that later. Third, support and resistance levels are self-fulfilling. Traders expect price to react at these levels, so they place their orders accordingly. This collective action makes those areas even more interesting. Now let's dive into the minds of buyers and sellers at these key price points. At support levels, buyers tend to step in, seeing the price as a good deal. They believe the price is undervalued and expect it to rise from this point. This buying pressure often causes the price to bounce off support. At resistance levels, sellers become more active. They view the price as too high and anticipate a drop, leading to increased selling pressure. This behavior creates a self-fulfilling prophecy. As more traders watch these levels and act on them, their collective actions make the levels more likely to hold, at least temporarily. Market memory plays a crucial role in shaping these zones. Traders remember past price levels where significant buying or selling occurred. These memories influence future trading decisions. The concept of trapped traders also contributes to market memory. Imagine a trader who bought at a certain price, only to see the market drop. He might be eager to sell at break-even when the price returns to his entry point. This creates resistance, as these trapped traders exit their positions. Support and resistance zones often form around round numbers, ending in 0 or double zeros. This is partly due to the psychological comfort we find in round numbers. Many traders place orders at these levels, creating natural support and resistance. The strength of support and resistance levels can change over time. A level that's been tested multiple times without breaking becomes more significant in traders' minds, but it also becomes more likely to eventually break, as more traders are watching it and positioning themselves around it. When a support or resistance level does break, the ensuing price move can be dramatic. This is because many traders place their stop-loss orders just beyond these levels. When the level breaks, it triggers a cascade of orders, accelerating the price move. This behavior is often exploited by large market players, who might push the price through a level to trigger these stops before reversing the move. High-quality support and resistance levels have several special traits that make them stand out on a chart. One of the most prominent features of strong levels is the presence of sharp, big reversals. These are points on the chart where the price makes a sudden and significant change in direction. For example, if price is falling rapidly, and then suddenly bounces back up just as quickly. This sharp reversal could indicate a strong support level. These dramatic price movements suggest that there's a significant imbalance between buyers and sellers at these levels, leading to quick reversals. High-quality support and resistance levels often show multiple instances of price bouncing off them. This repeated behavior reinforces the importance of these levels. For instance, if you notice that a stock price has bounced up from a level several times, this could be an important support level. These multiple bounces demonstrate that traders consistently recognize these levels and act on them, creating a self-fulfilling prophecy. Swing highs and lows are another important feature to look for, because they represent areas where the balance between buyers and sellers shifted significantly. High-quality levels often demonstrate the ability to act as both support and resistance. This characteristic, known as role reversal, happens when a broken support level becomes a new resistance level, or when a broken resistance level becomes a new support level. This phenomenon happens because traders remember these levels and adjust their behavior accordingly. One of the key traits of high-quality support and resistance levels is that they are visually obvious on a chart. These levels should stand out clearly, even to an inexperienced trader. If you have to squint your eyes to identify a level, it might not be as significant as you think. The most powerful support and resistance levels are those that are immediately apparent when you look at a chart. This visual prominence is important because it means that many traders are likely to notice and act on these levels, increasing their potential impact on price movements. Support and resistance levels that have been recently respected tend to be more reliable than older levels. This is because market conditions change over time, and levels that were significant in the distant past may no longer be relevant. Look for levels that have influenced price movements in the recent past, as these are more likely to continue playing a role in current and future price action. Round numbers often act as psychological support and resistance levels. For instance, many traders might set their take-profit orders at $100 if a stock is approaching that level from below, or they might set stop-loss orders just below $100 if the stock is trading above it. This clustering of orders around round numbers can create noticeable support and resistance effects. The strongest support and resistance levels typically combine multiple traits. For example, a level might be a round number, have acted as both support and resistance in the past, show multiple bounces, and be easily visible on the chart. The more of these characteristics a level exhibits, the more likely it is to be a significant support or resistance point. And when drawing support and resistance lines on your charts, remember that they don't always need to be exact. Prices can sometimes break slightly past these levels before reversing, known as a false breakout. Or they might reverse direction just before reaching the level, an imperfect reversal. So you might need to draw a wider zone rather than a precise line to capture all the relevant price action. Now, before we continue, let us know in the comments what topics you'd like us to cover. Please tell us what you want to watch next. Now let's talk about support and resistance flips. When price breaks through a support level, it shows a shift in power from buyers to sellers. The former support level then often becomes a new resistance level. This happens because traders who bought at a support level and are now facing losses may sell when the price returns to that level, creating resistance. When price breaks above a resistance level, that level can become a new support level, as traders who missed the initial move up may buy at the former resistance, now viewing it as a good entry point. These flips demonstrate the psychological aspects of trading. Traders remember price levels where significant shifts occurred, and their collective actions around these levels can create self-fulfilling prophecies. The strength of these flipped levels often depends on how decisively the original level was broken. A strong high-volume break of a support or resistance level is more likely to result in a reliable flip than a weak break on low volume. The number of times a level has acted as support or resistance in the past also influences its strength after a flip. A level that has been tested multiple times before breaking is often more significant. When a support or resistance level is broken, wait for a retest of that level before entering a trade. If a former support level holds as new resistance, or vice versa, it can confirm the breakout. Sometimes, a level will fail to hold after flipping. For example, a broken support level might not hold as resistance. These failed flips can lead to strong moves in the opposite direction, as traders who were counting on the level holding are forced to exit their positions. When trading support and resistance flips, consider the overall market context. In strong trends, flipped levels are more likely to hold, while in choppy or ranging markets, they may be less reliable. Volume can provide additional confirmation. High volume on the initial break, and again on the retest, can increase the likelihood of a successful flip. And it's also important to note that not all support and resistance levels will flip cleanly or hold after flipping. The market is dynamic, and even strong levels can be broken under the right circumstances. One powerful aspect of support and resistance flips is that they often mark the beginning of new trends. When a long-standing resistance level is finally broken and then holds as support, it can signal the start of a significant uptrend. When a strong support level breaks and then acts as resistance, it might indicate the beginning of a downtrend. Liquidity runs at support and resistance are a key part of how big players move the market. These moves, also called stop hunts or liquidity grabs, aim to trigger stop losses and force traders out of positions. The reality is that big players need liquidity to enter and exit large positions. They often find this liquidity clustered around support and resistance levels. That's where many traders place their stop losses and entry orders. Think about it. If you're buying at support, where do you put your stop loss? Usually just below that level. If you're selling at resistance, your stop is likely just above. Big players know this and use it to their advantage. A typical liquidity run might look like this. Price approaches a key support or resistance level. It briefly breaks through, triggering stop losses and breakout entries. Then price quickly reverses, trapping traders on the wrong side. These moves can be frustrating if you're caught in them, but they're not random. They serve a purpose for big players to build positions at better prices. For example, if big players want to buy, they might push price down to hit stop losses below support. This creates selling pressure, driving price lower. The big players can then buy at these lower prices before letting price rise again. To protect yourself from liquidity runs, use wider stops. Don't place them just beyond obvious levels. Also, wait for confirmation. Never enter on the first break of a level. But you can do more than just avoid these traps. You can profit from them by thinking like the big players. Instead of buying at support, wait for a potential stop run below it. Then buy when price starts to recover. You're now buying at a better price, aligned with the big players. And resistance, wait for a push above the level before looking to sell. This strategy requires patience and practice, but it can lead to better entries and less risk. Remember, liquidity runs often happen at the most obvious levels, previous day highs and lows. Round numbers, major swings, and levels tested multiple times are prime targets. To spot potential liquidity runs, watch for price approaching a key level with increasing momentum, price action that seems to defy logic or previous patterns, unusual volume spikes near the level, quick reversals after breaking a level, unusual candlestick patterns with long wicks or dojis, and multiple tests of a level in a short time. These patterns suggest big players might be trying to trigger stops or attract breakout traders. Of course, not every break of support or resistance is a liquidity run. Sometimes levels break cleanly. The key is to watch how price behaves after the break. In a true liquidity run, price usually reverses quickly. If it continues strongly in the breakout direction, it's more likely a genuine move. To profit from liquidity runs, you need to be patient and disciplined. Don't chase the initial breakout. Wait for signs that the move is losing steam or reversing. For example, if price breaks below support but starts to form bullish candles, it might be time to consider a long trade. Your stop can go below the recent low, giving you a tight risk. This approach aligns you with how big players trade. They're not trying to pick exact tops and bottoms. They're looking to enter after the liquidity run, when smaller traders are getting stopped out or chasing the move in the wrong direction. Also consider the bigger picture. Liquidity runs on lower timeframes might be insignificant noise in the context of larger trends. Always start your analysis on higher timeframes to identify the most important levels. Another tip, a liquidity run that goes against the main trend is often a good opportunity to enter in the trend's direction. If the overall trend is up, a stop run below support might be a great place to buy. As you gain experience, you'll start to see liquidity runs as opportunities rather than threats. Volume is a key tool in trading support and resistance. It's like a secret code that reveals the strength of these levels. When you mix volume with price action, you get a powerful method called volume price analysis. As you already know, not all levels are the same. Some are strong and some are weak. And how do you know which is which? That's where volume comes in. Think of volume as the fuel that drives the market. When there's a lot of volume at a price level, it means there's a lot of interest there. This can create strong support or resistance. The volume profile tool is great for finding these key levels. It shows you where most trading happened. The areas with the most volume are often important support and resistance zones. When you look at a volume profile, focus on three main levels. First, the point of control. This is where most trading occurred. It's often a strong support or resistance level. Then, the profile high. This can act as resistance. And lastly, the profile low. This can act as support. These levels matter because they show where buyers and sellers were most active. They're like battle lines where the big players fought over price. When price nears a key level, watch the volume closely. If price breaks through with high volume, it's often a real breakout. But if it breaks through with low volume, it might be a fake out. On the flip side, if price touches a level and bounces off with high volume, that's a strong rejection. It means the level held firm. But if it bounces with low volume, the level might not be as strong as it looks. Here's a cool trick. When price makes a big move away from a level, use the volume profile to see where the most trading happened during that move. That spot often becomes a new support or resistance level when price returns to it later. Let's say you see a big price drop. You can put a volume profile on that drop to find where the most trading occurred. That area might become resistance when price rises again. If it does, it could be a great place to sell. Remember, the market moves in waves. It trends for a while, then pauses in a congestion phase, then either keeps trending or reverses. Understanding how volume works with these moves is key to reading the market. When you're looking at a potential trade, don't just look at the price. Check the volume too. Is it above average? That's a sign of strength. Is it below average? That might mean the move is weak. If you're thinking about buying at support, look for high volume as price touches that level. That shows strong buying interest. If you're thinking about selling at resistance, look for high volume there too. That can mean strong selling pressure. As we already talked, false breakouts and liquidity runs are common traps in trading. When price breaks through a key level, don't just jump in right away. Wait for volume to confirm the move. A true breakout should come with above average volume. And if volume is low, it might be a fake out. But here's a cool trick. Sometimes, a failed breakout can be an even better trade. If price breaks out on low volume and then quickly reverses, that can be a strong signal to trade in the opposite direction. Don't forget about timeframes. What looks like a breakout on a 5-minute chart might just be noise on a daily chart. Always check higher timeframes to get a big picture before making your decisions. Learning to read volume in conjunction with support and resistance takes practice, but it's worth the effort. You'll see trading opportunities you never noticed before. Trading support and resistance will differ, considering if the markets are trending or they are ranging. And most traders don't think about this aspect, which is a major mistake. In a strong trend, support and resistance levels can help you catch big moves. When the market is trending up or down with force, it's not wise to fight it. Instead, look for ways to join the trend at good prices. Here's how to use these levels in a strong uptrend. As price climbs, it will often pause and drop back a bit. These dips often stop at old resistance levels, which now act as support. Sometimes price will move sideways for a while. This is like a pause in the trend. It can form a small range near a support or resistance level. Watch for breakouts. When price breaks above the high of the consolidation, it can signal the trend is ready to continue. In a strong downtrend, you'd use the same ideas, but in reverse. Look for bounces from resistance, consolidations, and breakdowns below support. Ranging markets are trickier. Price bounces between support and resistance without a clear direction. Here's how to use these levels. First, identify the range. Look for clear areas where price has turned multiple times. Wait for tests of these levels. As price approaches support or resistance, watch closely. How it acts here can tell you a lot. You then look for rejection signals. If price touches support and bounces up with force, it might be a good time to buy. If it hits resistance and drops hard, consider selling. Be cautious of false breakouts. Price often pokes above resistance or below support, only to reverse. Look for wicks or multiple wicks outside the range. Watch for consolidations near the top or bottom of the range. A consolidation within the consolidation. If price forms a tight range, it can signal a potential breakout. Of course, use volume. High volume on a bounce off support can signal a strong move. Low volume might mean the move is weak. In ranges, you're often looking to buy near support and sell near resistance. But be ready to change your view if the range breaks and a new trend starts. And consider the time frame. Levels on a daily chart might not match what you see on a 5-minute chart. Be clear about your trading horizon. Here are some useful tools for finding hidden support and resistance levels. First one involves Fibonacci retracements. These use special ratios to find hidden price levels. This is how to use them. First, find a big price move, up or down. Then draw a line from the start to the end of this move. The tool will show you the main levels of this move, and these levels often act as support or resistance. That's because many traders watch them. When lots of people act on the same levels, it can make them work. In an uptrend, price might pull back to these levels. They could act as support. In a downtrend, price might bounce off these levels as resistance. But you don't just buy or sell at a fib level. Wait for price to show it's respecting the level. Use fibs with other tools. They work best when they line up with other support or resistance levels. This is called a confluence. Pivot points are another great way to find daily levels. They're based on previous days' high, low, and close, and they can show possible support and resistance for the current day. This is how to use pivot points. First, look for price to pause or turn at these levels. If price is above the main pivot, it might be bullish. Below the pivot might be bearish. Use S1 and R1 for first targets, S2 and R2 for bigger moves. Watch how price acts at the pivot. A break above or below can signal the day's direction. Pivot points work well in ranging markets, and they're less useful in strong trends. Remember, using just one tool isn't enough. Smart traders combine methods. So look for overlaps. If a fib level, pivot point, and round number all line up, that's a strong level. Also, use multiple time frames. A daily pivot might match a weekly fib level. And add price action. Watch for candlestick patterns at these levels. Time frames play a big role in finding and using support and resistance effectively. These levels gain strength when they are visible on higher time frames. A level that shows up on a daily chart is often more significant than one on a 5-minute chart. This is because higher time frame charts represent more trading activity and longer-term market sentiment. When you spot a level on a higher time frame, it often acts as a stronger support or resistance point. More traders are likely watching it, and it may take more buying or selling pressure to break through. For example, if you see a clear support level on a weekly chart, it might hold even if price dips below it briefly on an hourly chart. This is why many traders start their analysis on higher time frames and then zoom in for more detail. Lower time frame charts can show you more precise entry and exit points. They are also useful for short-term price action around major levels. On lower chart, you'll see early signs of a level breaking or holding. But remember, lower time frame moves are often just noise in the bigger picture. A level that looks important on a 5-minute chart might mean nothing on a daily chart. The solution for combining the higher with the lower charts is a multiple time frame analysis. Here's how to use it. Start with a higher time frame to get the big picture. I like to use the daily chart. Then move to your trading time frame to find specific setups. The hourly chart is a good one. Then use a lower time frame to fine-tune entries and exits. Of course, you may use other combinations. You might use a weekly chart to find major levels, a daily chart to identify trend direction, and a 4-hour chart to enter trades. This is a very important strategy. It will help you understand the overall market context, and you'll avoid trading against the bigger trend. Plus, you'll find better entry points for your trades. Now, if you liked what you saw, we have plenty more interesting trading guides for you.